Dr. Minetti is the president and owner of Minetti CPA. Dr. Minetti is a CPA, CFE, CVA, a math, CGMA, CFF, and CRFA. He's a licensed private investigator in the state of Arizona. He teaches graduate and undergraduate courses for multiple universities. And with that, I will turn it over to Robert Minetti. Thank you for being with us.
And thank you for that fantastic introduction. So let's jump into our objectives for today's webinar. Once you complete this class, you're going to be able to identify economic damages associated with the COVID-19 pandemic. And I've also put some in there that are associated with civil unrest, because these are kind of working hand in hand. And a lot of what we'll be discussing today could also be used to help document economic damages for the recent hurricanes, or if you're on the West Coast, the fires. So there's a lot of opportunities for economic damage engagements coming up, over the next 6 to 12 months. Now, the first question we talk about is, why do we need to document damages? Why is it important? Well, especially if you're going to do a insurance claim, the insurance company is going to want some kind of documentation. Historically, I found if a business owner sends a letter to the insurance company saying, hey, I lost this much money, send me a check, they'll put an underwriter out there and, they'll come up with some number, but it's not always, the best number. So we often do economic damage calculations to send in to the insurance company to give their underwriter the knowledge of this is what we've got, and also that the business owner doesn't forget things. There are many items when we're talking about economic damage calculations that business owners often forget to put in there. So because they don't do them on a regular basis, they tend to underclaim when they file their insurance policies. Now, we also could be looking at documentation for a casualty claim on income taxes. If the value of the business has gone down because of COVID-19, where it was a direct result of the virus, or the government shutdowns because of the virus, the value of the business went down. So a classic example would be a restaurant where we had seating for 100 people. And now by government decree, we're never going to be allowed to have more than 25 people in the restaurant because of keeping 6 feet of separation. That reduction in seating capacity permanently reduces the value of the business and gives you a casualty claim on your income taxes. In the event of issues with civil unrest, you could also have a theft claim. We're also going to see a lot of documentation, I believe, to document the necessity for the Paycheck Protection Program and the Economic Injury Disaster Loan. Though the PPP program did give a safe harbor for businesses that had loans of less than $2 million, the issue is that you're still looking at any business with a PPP loan of over $2 million is going to have to document the economic necessity of the loan. EIDL loans don't have a safe harbor, so it may be necessary to document that. And of course, if the SBA determines that they need to audit some of these loans to determine where they appropriately applied for and used, that could also require documenting the necessity for the loan. Documentation for litigation. We're looking at a lot of potential litigation, especially because of the government shutdowns that occurred because of the virus. Businesses were not able to deliver products on time. They weren't able to deliver services on time. They were closed. Gyms that charge an annual or monthly membership and their members paid in advance and the gym closed and they couldn't come. Well, people want their money back, or they're going to sue because of lack of performance. We're already seeing tons of litigation for economic damages for people for wrongful termination, that you use the virus as an excuse to terminate somebody that you couldn't have otherwise terminated, or there would have been possibly a discrimination or other complaint, but you tried to do it under the course of that. Also, economic damages because an employee or customer got the virus at your business. They came into your business, you were negligent, you didn't have the proper personal protective gear available, it wasn't sufficient, people got sick, and now they want to sue. and understand that, they always want to sue. There's always that opportunity to jump in and try to get money when they feel they've been wronged or hurt. And many people are looking at this as a way to recover the losses that they had because of the pandemic. We had 50 million people who were laid off. That's a lot of people whose lives were turned upside down and who were put in a bad economic situation. And finally, looking for documentation for the bankruptcy court. We've seen thousands of businesses shut down that are never going to come back. So we're going to have to document the economic losses, and potentially look at the issues, and also, filing proofs of claim when, vendors, customers, and others have, gotten into bankruptcy. So there's a lot of issues for us to work through here. Now, when we're dealing with insurance claims, we want to make sure that we review the insurance policy, that we understand what's included in the insurance policy so that we can make sure we scope it out and we have a proper scope for our engagement. A lot of business interruption policies have exclusions for bacterial, viral, or pandemic causes. There's also a lot of class action lawsuits going on against the insurance companies because those exclusions were in the very fine print and the agents never mentioned them to anybody or specifically told the clients that those exclusions were in there. Also, some policies have exclusions for acts of war or civil unrest. So if you were in an area where that civil unrest occurred, guess what? They're going to exclude any claims that occurred from that. We need to make sure we understand what the coverage amount is, and knowing that the insurance company is never going to pay more than the coverage amount. That's the maximum amount they have to pay. But we also have to determine the deductible. How much is the client going to have to pay? How much is the company going to have to pay? That deductible could turn around to be, a casualty claim on a tax return as well. So the amount they pay for the deductible, they could still have some chance for recovery. We need to document what loss mitigation steps have been taken. Did you provide personal protective gear to your employees? Did you have masks available for customers who walked in the door and didn't have them? Did you follow the government rules for wearing masks, gloves, and other personal protective gear? Obviously, you need to make sure that the insurance company's been notified of the claim coming up, and we assist the client in filing the initial claim. Now, one of the areas where we're having some interesting discussions is, looking at trying to determine if you're in an area that had multiple issues. In this case, you had COVID-19 damages, civil unrest damages. If you were in the Gulf Coast, hurricane damages. If you're on the West Coast, fire damages. I believe in the Midwest, we had a dam that broke, so we had flood damages. And they're all piling up on top of each other. So part of what happens is, let's say, you're in the middle of COVID-19, you're shut down, you have no revenue. And then you have a fire and your business burns down in California. Now the insurance company argues, well, you had no revenue the month before the fire, therefore you have no economic losses. So we're having those discussions of how we determine how are we going to calculate those economic losses when we have multiple catastrophes piling one on top of the other. And we're still working that out, and there may be a lot of litigation that occurs to make the final determinations on that, because as I'm sure you're aware, the insurance companies are going to protect their profit margin. Their argument is that they need to pay the least amount possible to settle a claim. And you don't blame them for that. They're in business to make a profit. On the other hand, the business owners need to recover what they got. They should be made whole. They shouldn't have to lose money because of these disasters, especially when they're insured. Now, we also have the opportunity for an income tax casualty loss. In a federally declared disaster area, that offers the opportunity to take a casualty loss on your tax return if the value of the business went down as a direct result of the disaster. Now, for the fires, the hurricanes, even the civil unrest, that's pretty easy to show what the losses are. With the COVID-19, we're getting a little more complicated because how much did the value of the business go down because of COVID-19? If you've got a barber shop, restaurant, or something else where we're going to permanently have to reduce capacity, we're not going to be able to go at the capacity that we had prior to the virus, then obviously you have a permanent value loss that's going to be a casualty loss. Now, all 50 states have been declared a disaster area because of the COVID-19 virus. Also, the District of Columbia and all U.S. territories. So basically, everywhere in the U.S. is a casualty, a disaster area because of the virus. So you can have business casualty losses, and you can also have personal casualty losses. And in the case of some of the civil unrest issues, we could have theft losses as well. So we need to remember that. Now, for personal casualty and theft losses, for any year after 2017, the losses have to be attributed to a federally declared disaster. Now, the hurricane in the Gulf Coast was a declared disaster. I'm not 100% sure on the fires. I haven't seen the news report on that. But if they haven't been declared yet, they will be soon because those fires are really out of hand. So we need to understand, and look for that for our filing. Now, a casualty loss results for damage, destruction, or loss of property for sudden, unexpected, or unusual events. The traditional flood, hurricane, tornado, earthquake, civil unrest is an unusual event. And believe it or not, pandemics are an unusual event. The last one we had was over 100 years ago. Now, what you can include in casualty losses, it doesn't include normal wear and tear or depreciation or deterioration of the property. Okay, so the other thing, if the property is personal use property or it isn't completely destroyed, the amount of the loss is limited to the adjusted basis of the property, that's the adjusted tax basis, or the decrease in fair market value of the property as a result of the casualty. That's where we're going to see some opportunities for casualty losses, especially in the hotel, restaurant, hospitality industries, entertainment industries, movie theaters. Nobody's, what could you sell that theater or restaurant for in January of 2020, as opposed to what are you going to be able to sell it for at the end of the pandemic? And those losses could be significant tax losses that we're looking at for many businesses. Now, theft loss is pretty simple. Property stolen, and that includes inventory or fixed assets. Okay. Now, the theft loss, the IRS has a specific thing in there, has to be taken in the year the loss was discovered. That's mostly to cover fraud losses so that you don't have to go back and amend tax returns. If somebody's been committing fraud for 20 years against a company, we don't want to go back and amend all those tax returns. You take it in the year it was discovered. For civil unrest, we know when it happened. You showed up for work, the doors and windows were broken down, and all your stuff was gone. We're going to take it in 2020. So it's real simple. So the one thing about theft is, generally speaking, the adjusted basis of the property is what you're going to take as your theft loss, because the assumption is the fair market value of the property after the theft is zero. The recovery rates are so low for stolen property. The police very rarely recover the property. And if they do, it's usually damaged so much that it can't be used, that they simply assume that the fair market value is zero after a theft. And that's the presumption that's made. Now, there are limitations on personal casualty losses. For a personal casualty or theft loss, again, that has to be attributed to a federally declared disaster area, you have $100 per casualty and 10% of the AGI limitation. Okay, so you also have to remember, if you've got any money back from insurance or other things, you have to offset that loss. You can't double dip. You can't take a loss and get paid by the insurance. You're not allowed to do that. So that's one of the things that we want to make sure that we're taking a look at in how our clients are handling their accounting for the loss. Now, for a proof of loss, and this is for both tax and insurance purposes, you're going to need to show that you were the owner of the property, or that you leased the property, but you were contractually liable to the owner for the damage. In other words, if you leased a office building and you were required to return the office building in the same condition it was in, less normal wear and tear, which wouldn't be considered something that occurred because of, a fire or a hurricane or civil unrest. So we list the type of casualty, what caused it. Common ones we've seen: storms, fires, car accidents, the date it occurred. You don't have to go down to the exact minute, but you get the date in there. You have to document that the loss was a direct result of the casualty. With civil unrest, that's pretty easy to do. We showed up in the morning and all of our stuff was, removed from our store. It wasn't there anymore. It was stolen. That's pretty easy to document as a direct result. We may have a little bit harder time documenting some of the direct results from COVID-19 because it's a virus. You can't see it. And some of the things that the virus is occurring, customers are staying home. So even when we open up, we have a big reduction in volume. We're not having the sales we had before because customers are hunkering down in their homes and staying home under government decree. So they're not out spending and entertaining and going to bars and concerts and things that they used to do. That's a direct result of the virus. We can look at that and see, yes, we have direct results, And of course, is there any reasonable expectation of recovery? Should we be getting the money from some other source? If we're going to file for a tax loss, we have to offset any insurance money we got. If the insurance company, if there's more than one insurance policy in place, the purpose is to make the client whole, not to enrich them because of the disaster. So they'll offset for any other insurance that may have been in place. So, as I said before, with the casualty and theft losses, we also reduce by any salvage value. This is more often for casualty than theft, but if there was damage done to the property and there is some salvage value, for instance, there are things that could still be sold or they could be sold at a reduced price, that salvage value is going to reduce the insurance claim or any other reimbursement that you receive. And so we need to make sure we look at that. So we're always looking at that adjusted base of the property, which is usually your initial cost, which is increased or decreased by improvements to the property or depreciation. Now, I did want to talk a little bit about, coming in and talking about the economic necessity for the Paycheck Protection Loan, the certifications. So if you look at the third bullet point down, it says, current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Now, part of the problem here is that they didn't really define what current economic uncertainty means. So we have a problem here is that we can't necessarily, state an opinion that yes, that's there, but what we do have to do is take a look at how do we support that for the client. If the client comes under audit, and again, they signed off under penalty of perjury that was an issue, the question is, how do we document that for the SBA? And for all loans over $2 million, they're automatically going to be audited. So if you have a client who received a PPP loan of over $2 million, the audit is automatic. So we're going to have to justify to the SBA the economic necessity of that business taking the loan. Remember, there was a big to-do because a lot of very large businesses, I believe Ruth Chris Steakhouse, LA Lakers, Harvard University came in and took, tens of millions of dollars in loans. And basically the government said, wait a minute, you're not a small business. You've got all kinds of opportunities to raise capital without relying on the PPP loan. They did give them a safe harbor, and most of those businesses returned the money, saying, yeah, okay, we understand we shouldn't have done it, and here's the money back. And the government took the position of no harm, no foul. But again, for any PPP loan over $2 million, it's an automatic audit. And we're going to have to justify the economic uncertainty that was there. Now, for small businesses, economic uncertainty could have been, delays in getting receivables. I had that happen for my business, a number of clients who have never been late on their payments. And I called them up and said, hey, I haven't gotten your payment. That's unusual for you. And they said, Bob, we got an issue here. We had to send all our employees home. They're working from home. And needless to say, we didn't send blank signed checks home with the employees. All the checks are in the office. Once the governor lifts the shutdown and we can go back in the office, we'll be glad to send you a check. And of course, once the shutdown was lifted, they sent me the check. But for a while, there was definitely some uncertainty there. Was I going to get paid or not? How long was those shutdowns going to last? Some of them are still in effect. Some businesses still haven't been allowed to have employees come back into the building. And so that becomes an issue. So we got that. We've got the ability to get products. How are our supply chains affected? We saw in the city of New York for a while, truck drivers weren't willing to drive into the city because they were afraid of getting the virus. So they weren't delivering goods and inventory items. Other places we've seen factories shut down, meat processing plants shut down. They weren't able to deliver the contractually obligated things in their contracts. They couldn't meet those performance obligations, and therefore there were going to be issues. That created economic uncertainty. If you can't get inventory to sell, you're not going to be open very long. So that's a big issue. So as I said, the reminder is that the SBA reminded everybody that, what we're looking at is that, anything over $2 million is going to be audited. Under $2 million, they gave a presumption that smaller businesses were going to need it. And they did remind everybody to carefully review on your application that concept. And you had until May 14th, 2020 to repay those loans. Now, when we look at the EIDL loan, which was another loan that was set up to help small businesses because of the economic issues with the COVID virus. So with this, the basic requirements were good credit history, ability to repay the loan, but more important, has the business suffered or will likely suffer some type of substantial economic injury as a result of the disaster? So if the business gets audited, and for the really small businesses, if you've got a small mom and pop business that got a $25,000 or $50,000 loan, the odds of getting audited are pretty slim. As a matter of fact, there was a bill put before Congress that, for the PPP loans, any company that got less than $150,000, they were just going to automatically forgive it, and you didn't even have to put in the forgiveness application. Unfortunately, that bill, like everything else before Congress, is currently stalled, and nobody's expecting anything to pass until after the elections because they can't seem to agree on anything, and that's both sides. I'm not picking on one or another. I'm just making a statement of fact that they can't agree on what needs to be done, so that means nothing's getting done. So we have to be aware of that. We could see some huge changes coming out in November once we know what's going to be happening, with the, election, and that could make some major changes in how we're going to handle some of these economic injury calculations. Now, remember, we had to say that everything we put in there was truthful and that the application was correct, including that economic necessity for getting the business, that we had that issue, that we understood the concept that there was some type of harm to the business that required them to apply for the loan. Now, the other thing we'll be looking at is litigation and bankruptcy. And we're going to be looking at economic damages because of these cases, or assisting small business clients through bankruptcies. Now, litigation, some of the things that we're looking at: delayed performance. If your business was shut down, your factory was shut down, obviously you weren't delivering your product to your customers. Your contract said you were going to deliver products on certain dates. Do they have the right to sue? Absolutely. Delayed payments. I've already given you an example of one that happened to me. Impossibility of performance. You're still shut down. You're not allowed to open. The government won't let you do any work. How are you going to perform? We're also seeing a rash of cases for wrongful termination, and for both customers and employees who are claiming they caught the virus at work. Employees who were told, you have to go to work, you're an essential employee, we expect you to show up. They got the virus because they were told they had to show up, and guess what? Now they're suing. They want to get paid. They want compensation for that. Customers who went into your business and you didn't have the shields up, your employees weren't wearing masks. Somehow they look at negligence because they caught the virus at your business. Unfortunately, because of the hard times, we had 50 million people laid off of work, some of the other issues, we're seeing a lot of divorce litigation. Divorce numbers are skyrocketing because of the virus. And of course, we're looking at bankruptcy. We can look at Chapter 7 bankruptcies. That's a liquidation for both individuals and businesses. Chapter 11, which is a business reorganization. Chapter 5 is a new chapter. It's actually a subchapter under the Chapter 11. It's a reorganization for small businesses. This is for the very small businesses. There's no creditors committee. The rules are a lot simpler. The costs are a lot lower, because most small businesses couldn't make it through a Chapter 11. The costs of the Chapter 11 were wiping them out. They had no opportunity to continue. The Chapter 5 was put in place to allow some of these small businesses to have an opportunity to continue as a going concern and continue to employ people. And of course, the Chapter 13, which is the personal reorganization bankruptcy. So let's talk about economic damages, because that's one of the things that we want to make sure we cover. Now, for businesses, the basic types of economic damages that we've seen are, loss of income. That's a big one. We can't get the revenue we used to have because of whatever the cause was, the virus, civil unrest, or other issues. Obviously for civil unrest, it's damage to property. That we have to replace inventory, windows, doors, clean the graffiti off the walls, whatever. There's also infringement for copyrights and patents. I don't think the virus is going to cause any major additional work there. Now, for individuals, the things that we've got: personal injury. I got the virus and it's your fault. And you can see individuals suing each other. I ran into you in the street, you breathed on me and gave me the virus, now I want to sue you. How that lawsuit will turn out, I don't have the faintest idea in the world. But technically, if you gave somebody a disease and that caused them medical bills or other things, you have a right to recoup those expenses. Wrongful termination, oh yeah, you picked on me, you got rid of me because of the virus, but you kept other people, and then they're going to claim some type of discrimination. Wrongful death, you told me I had to go to work because I was an essential employee. You told my spouse or loved one they had to go to work because they were an essential employee and they died from the virus. Obviously, we want compensation. Now, there has been talk in the Senate of passing a bill that would limit the litigation for the virus, but again, it hasn't gotten anywhere. And, there's a lot of talk of additional stimulus packages and things they might do, but pretty much everything at this point is stalled. Nobody's doing anything. Now, when we look at economic damages, we need to make sure that we're considering how we're calculating them. We start by looking at the earnings before the trial, had the harmful event not occurred. Now here, if we've got multiple harmful events, we've got COVID-19, civil unrest, and a hurricane or a fire, guess what? We're really going to have to be very explicit on how we break down those differences. Then we look at the actual earnings before the trial, and we add prejudgment interest, and that's the damages that come up before we go to trial. Now, then we look at the projected earnings after the trial, once again, had the harmful event not occurred, and the projected earnings after the trial, again, assuming that things are going to be in a reduced capacity or back to normal. We always have to discount back to the present value, and that gives us the damages after the trial for the total judgment that we'll be asking for. And this is what we have to support if we go to litigation. Obviously, if we can settle in a lot of these cases, especially with insurance companies, we're going to get through them in the settlement phase. We're going to come to some type of settlement agreement through either a settlement conference or an arbitration, but occasionally we do have to go to trial on these. Now, for individuals, these are individuals who got the virus at work or at a store. They were a customer and got the virus there, or they went to their gym and caught the virus there. They're going to look for damages. This also includes wrongful death and termination. Some of the things that we need to calculate and consider. We're looking for, the earnings, lost earnings, including bonuses, commissions, lost promotions, pay raises, stock options, any long-term damage to their ability to earn. This would probably more for the people who had to actually go on the ventilators. There are any projected future earnings they still might be able to get after they recover. We look at the effect of the event on income generating businesses, interest, dividends, and royalties, which are less likely to be affected. We also need to consider fringe benefits like retirement benefits, the loss of health, life, or disability insurance, accumulated vacation and sick time that they lost or weren't given. And then we look at other expenses that may have been added in. Household services, if you're sick and you need to hire someone to come in and clean your house, or if you had to get child or dependent care services, medical or rehabilitation expenses that weren't covered by the health insurance policy. Now, economic damages for businesses include lost and delayed revenues, delayed receivables, voided contracts, waiving late fees and interest. I did that for a lot of my customers because I didn't think that it was their fault. They weren't allowed to go into the office, and you want to make sure that you keep that customer relationship. Deferred payment receipts, collection costs on receivables, repossession costs, foreclosure costs, eviction costs, writing off receivables and debts that aren't collectible. These are all part of our economic damage calculation. We also want to look at the increased expenses, lost inventory, damaged inventory, stolen inventory, the cost to board up a closed business, or putting security guards in place to make sure that there's no additional damage. The actual damage assessment cost, having us come in and do the assessment, how much was the damage, is part of their damages. That always surprises people. Don't forget you get to include your forensic accountant and lawyer fees in the costs. Damages to fixtures, buildings, signs, windows, all your legal fees, your investigative fees. And that includes the time employees have to take to figure out what was damaged, what was stolen, what's missing. All that employee time that you're paying the employees for becomes part of the economic damages for the business. Now, we also have some new net operating loss rules, and these were part of the COVID-19 stimulus packages. So for net operating loss for taxable years beginning after December 31, 2017 and before January 1, 2021, if we have a net operating loss, we can carry that back for the last 5 taxable years. Now there are some special rules for real estate investment trusts and life insurance companies, and they're very, I'm not going to cover them because this is a 1-hour course and I can't cover everything in an hour, but just to let you know that's out there. So you have the opportunity to go back and file amended tax returns if you have a net operating loss in 2020 and get tax refunds from the previous years. Or if you didn't have enough money to get a refund, you can carry those losses forward for the next 20 years. Now, when we look at economic losses, one of the methods we use is the benchmark approach. Okay, so what are we looking at? We're looking at the financial performance of the company or the individual compared to other companies or individuals in similar situations that didn't suffer a loss. Unfortunately for COVID-19, it's going to be hard to find people that didn't suffer some damages because of the virus. I think maybe Amazon would be one example. They've actually been raking in the money as everybody's been ordering online rather than going to the store. But this gives the evaluator a guideline to how the company or individual could have performed had the harmful act not occurred. So this will be more useful for the civil unrest type of damages than the COVID-19, because for COVID-19, basically everybody's been affected. So another methodology we can use is what's known as the before and after method. We look at the financial performance of the company before the virus was identified or before the civil unrest occurred, and we compare it to the performance after the incident. If we had a government shutdown, we can look at the income the business had prior to the shutdown and then compare it to the business that happened after the shutdown or during the shutdown. And that difference in revenue could be our economic losses. And we also want to look at the underlying contract method, that there are contracts out there that we want to look at. Damages associated with delays in performance, breach of contract, inability to perform, or other contractual damages. Now, I always remind you that when you are doing damages, you need to bring them back to the present value. So we're going to look at the future cash flows and bring them back to the present value. I've given you the formula here. If you want to do this on your own, feel free to do so. I use spreadsheets or software. I'm not going to try to do that math with a pencil and paper. I had to do it in college to pass the test and haven't done it on pencil and paper since then. Now, when we talk about economic losses, we look at the ex-ante losses. These are the losses that occurred or are projected to occur after the date of the incident and are discounted back to the date the incident occurred. And the ex-post damages are lost profits that are projected to occur after the date the economic damage assessment was conducted, and they're discounted again back to the date of the analysis using present value. Now, when we're doing losses, we may need to do a business valuation. The two things we could be looking at, well, there's actually 3 types of business valuation engagements. A typical valuation engagement where the evaluator applies their different approaches and methods based on their professional judgment to come to a conclusion of value. A calculation engagement occurs when the client has already agreed to a specific approach and methodology for doing the valuation. These are usually done for business buyouts, partnership buy-ins, partnership buyouts, or they're included in prenuptial agreements where a specific type of valuation occurred. And then there's, of course, a review engagement where somebody's hired to review a valuation or calculation done by another evaluator. Now, when we're talking about looking at the lost value, remember we're going to be looking at 2 valuations. The first valuation gives us the value prior to the disaster or the start of the COVID-19 pandemic. Okay, and remember that each state has a separate disaster declaration date, depending on when they requested and when the president signed their documents. The second valuation is done when the disaster declaration is lifted. It could be the end of December. We thought that. Now we're saying it may not be until 2021 or even 2022. Now, when we look at doing business valuations, if it's a publicly traded company, figuring out the value is easy. We take the stock price times the number of shares that the person owns, and that's the value. The problem is non-public businesses are a lot more difficult to value. They don't have that same amount of information. It's not public. It's not recorded. You can't go on to Bloomberg and see the stock price for a small mom and pop business. There are sources for gathering this information, and one of the basic sources that we use is the revenue rulings put forth by the IRS. The reason we do this, courts like us to use methodologies and approaches that have been approved and peer-reviewed and substantiated. And the courts generally like the opinion that if the IRS says it's okay, then the court's going to go along with it. It's that presumption that, they always want somebody else to be the, driving force. They don't like to make new laws. They like to follow precedents. So if a government agency like the IRS says this is what we do, then the courts are going to follow along and say, man, that's okay with us. Now, Revenue Ruling 5960 was issued by the IRS back in 1959 and outlined the methods and factors for valuing closely held businesses. It was predominantly for estate and gift taxes, but we widely apply those same methodologies today. There have been some modifications to it. Revenue Ruling 65-193 gave us the opportunity of separately valuing tangible and intangible property in a valuation. Another one to consider is Revenue Ruling 77-287, which gave us the discounts for lack of marketability and open up the opportunities for various types of discounts in our valuations. Now, when we do a valuation, there's basically three standards of value. The first is the fair market value. That's the value the property would change hands at with that hypothetical willing and able buyer, that arm's length transaction you learned about in your accounting courses. Fair value is a value set by state statute. A lot of the states conform to the Uniform Business Corporation Act, but they have a way of calculating fair value that's written into the statute, and you need to follow the value for the state where you're doing the valuation. An intrinsic value is value that could be added to a particular investor because of synergies. They're getting a good location. If I want to expand my factory, the land next to my factory has more value than land 10 miles away because I want to expand it locally. Or if I want to buy a supplier or a vendor and reduce the issues with my supply chain, that can have a synergistic or intrinsic value. Now, once we get the standard of value, we need to determine the premise of value. That could be book value, which is rarely used because book value is the purchase, your basic acquisition cost less depreciation. You could be looking at the going concern value. What's the value of that business as it continues to operate? This could be a major valuation. The going concern value will probably be the primary one we use for COVID-19 cases, because what was the going concern value prior to the virus, and what's the going concern value once the virus has done its damage? Liquidation value is basically what happens if we just sell off all the assets today. Replacement value, this would be a big one that we'll be looking at for civil unrest issues. What is it going to cost to replace the inventory, the windows, the signage, everything that was destroyed during the civil unrest? Orderly disposition is, rather than a fire sale liquidation, we try to sell the stuff in a manner that maximizes the amount of money we're getting. The other valuation that's often done is assemblage of assets. That's often done when we sell a small business because nobody wants to buy an interest in the small business and take on the liabilities. They just want the assets. So when we put our valuation together, we start by looking at economic conditions, and we're going to have a thorough discussion of COVID-19 and how it's affecting the economy. We do a financial analysis of the business and we normalize the financial statements. We need to make sure we identify the valuation approach and methodology that we use. We apply the discounts and premiums to come to a conclusion of value. So the basic analysis we're going to put in there. What's the nature of the business? The history of business. What was the economic outlook? In this case, we might be looking at a global, national, statewide, local. How did the pandemic change the economic aspect for this business? What was the adjusted book value of the items in the business and the financial condition of the enterprise? How was its earning capacity affected by the disaster? Has it, have there been issues with goodwill or other intangible value? Were they affected or not? In some cases where there's civil unrest, the brick and mortar part of the business might be damaged, but the website might still be up and running. Of course, if all the inventory was stolen, that's going to be another issue because you can't fulfill those website orders. Have there been any prior sales of the business or interest in the business that we could use to help to value it? We want to look at the size of the interest that we're valuing. Is it a controlling interest or a minority interest? How liquid is it? Some businesses are hard to sell. If you're trying to get a partner for a brain surgery partnership that requires they be a brain surgeon, the number of people who can buy in is probably very limited. We look at market prices of interests in other enterprises. This is the market approach. We look at hypothetical conditions that are appropriate for the circumstances and include other information that the evaluator deems to be relevant. Now, when we talk about the approaches, there's basically 4 categories: the asset approach, the income approach, market approach, and then we go to what we call other approaches. So asset approaches include the book value method, which can be done, but isn't usually done because of, the issue is depreciation is a non-cash. It doesn't really give us the true value of the assets. So a lot of times we're going to use an adjusted net asset method using the replacement cost premise, the liquidation premise, or the going concern premise. Once again, for the COVID-19 virus, I think we're going to be strongly depending on the going concern premise because we want to look at what would that business be worth long term. Then for the income approach, we could be looking at the capitalization of earnings, capitalization of cash flows, or discounted earnings, or the discounted cash flow methods. This is more appropriate for service businesses, tax firms, accounting firms, law firms, businesses that are service related rather than having large amounts of inventory, such as retail businesses or factories. And of course, the market approach is out there, and there's, we look at that. The market approach is one most people are familiar with. It's probably what you've seen if you ever bought a house. They look at comps in the neighborhood, what have other houses in the neighborhood sold for, and they compare them to your house. You make the adjustments and then, figure out what it's worth. That's how the market approach works. We can look at, the guideline public company methods, trying to compare the company to, public companies, or looking at prior sales, whole or partial sales of the business. And some of the other approaches out there, the excess earnings method, there's the reasonable rate method and the treasury method. And a lot of times we just do sanity checks to make sure that, we're not way off base once we come to our conclusion of value. Now, our levels of value that we want to look at, that synergistic value, did, getting this acquisition, increase because of synergies that are involved? Did we get a controlling interest? A controlling interest is always worth more than a minority interest because you have the final say. And with minority interest, we break it down further. Is it a marketable minority interest? Is it something that would be easy to market? Or is it a non-marketable minority interest? We then apply the premiums and discounts, and we could be looking at a control premium. Obviously, somebody pays more when they maintain control of the business. We look at the marketability discount, the minority interest discount, key person discount. The key person, the founder of the business, is no longer going to be there. That's going to reduce the value. Are there any restrictive agreements? Is there a lack of voting rights or a blockage discount? Finally, to complete the report, we come to that conclusion of value, which can be expressed as a single number or a range. I always recommend, and especially in today's world, you want to use a range. Don't come up with a number, $3,743,218.27, because trust me, the lawyers are going to rip you apart on cross-examination for that one. You want to come up with a value. This is worth somewhere between 1.3 and 1.4 million dollars, so that you have some room to work with. And remember that evaluator can basically rely on any information that's provided to them from any source. You don't have to corroborate the information. You don't have to audit the financial statements, but you do need to disclose the fact that you didn't corroborate the information with a second source. You didn't audit the financial statements. All of that needs to be included in your report. I know we're running at the hour point now, so I want to make sure that we have a few minutes to answer any questions that may have popped up. Let me see if I can get over to the Q&A and see what's up there. Book value, that's really more of a comment than a question. I don't see the question there, but basically, yeah, there are some, there aren't very many times that book value is used, for evaluation. Mike, you're right on that one. As I said, the issues with depreciation, the acquisition cost, unless you're dealing with like a brand new business that was started, right at the beginning of the year, then you might have an opportunity for that. Can I give you the IRS regulation, which allows a casualty loss related to a decline in the business value? Not off the top of my head, Jessica, but if you send me an email, I can send it to you. I don't memorize all the numbers that go along with these things. Sorry about that, but just not that good. Mention a permanent reduction in the value of the business. How will we define permanent? How much time before we can call it a permanent reduction? Hate to tell you, but that's called a professional judgment, Kelly. Right now, we don't know because this is unprecedented. We don't have anything here where we can say, I want to go back and look at how this was done in the past. The unfortunate problem is the last time we had a pandemic, in 1917, the tax code was only a couple years old. Remember, it went into effect in 1913. So it's not like they really had the issues to deal with back then because the tax code was so new. And it's become much bigger and more complex. The IRS does a lot more now than they did back in 1917. So some of this stuff we're going to be working through as we go, which is why, with the NACVA, we're holding these courses, we're holding discussion groups, we're having panel discussions and other things to talk this stuff out. Because for, a lot of us, we haven't lived through a pandemic. Unless you're over 100 years old, you haven't been through this before. So what are the changes that are going to go out there? I wish I had every answer. Unfortunately, that one I don't have. Looks like that's all the questions we've got so far. Obviously, if you have any other questions, feel free to email them in. They'll send them to me. I'll get back to you with an answer. Also, I always accept LinkedIn requests from anybody who attended one of my webinars. Feel free to send me a LinkedIn request. I'll be glad to get back to you and and give you an answer via LinkedIn. And so that's also an opportunity. So I want to make sure I thank everybody for attending today's webinar, and I hope to see you in one of our webinars in the future. Have a great day.
Robert, everyone, I did put his email in the chat box for you a little bit earlier. I think, and the slides were also, there was a link in there as well, but I will go ahead and do a name poll and send out the links, the PowerPoints or the PDF of the PowerPoints to everyone, just so you have them, just in case you didn't get them from the chat box. How about when the damages period is during 2020? We have 3 minutes. Robert?
Can you repeat the question?
How about the damages period? How about when the damages period is during 2020?
Well, if it's during 2020, then we can obviously apply it to the 2020 tax return, where we might have, we're going to have some, if the pandemic right now, everything's scheduled to disappear at the end of December 31, but some of the doctors are saying, well, it may not be the case. With the flu coming back, we may see things get even worse, and we may see another lockdown before the end of the year, which means we may have a damage period that exceeds a year, going beyond that February 15th date, maybe well into 2021. And so there's no way I can guess when that damage period is going to end, because even the best doctors out there aren't sure on that one.
Okay, and
I see one from Charles here. What happens if insurance companies won't pay business interruption insurance? That's what attorneys are for, Charles. Then we have to do the calculation. We do the economic damages. We go to court, and we ask the jury to decide.
Pandemic history is the only pandemic in history where cases include people who are not sick.
But we have people
I guess that's more of a
who were damaged by, if they got laid off, that's an economic damage. If they were terminated, that's an economic damage. And if the reason for that termination was the virus, they have economic damages.
Okay. All right, everybody. Thank you so much for attending today. Robert, thank you for your time as well. Always good to know about this kind of stuff. Folks, we got lots of this stuff in the future. Keep your eye on the website, and Robert's email is in the chat. Hope to see you again soon. Robert, take care. Everyone have a great weekend and be safe, and we'll see you next time.